The era of easy gas is over. We had a number of years now where we had associated gas that we did not know what to do with. Some of it we still are trying to, find a good use for. So there's some tough decisions coming up.
Welcome to The Next Imperative, a podcast hosted by A&M energy leaders tackling key issues and trends in the industry.
Welcome to The Next Imperative. On this episode, we're going to talk about U.S. natural gas strategies. Joining me are my A&M colleagues, Barak Powers, John Corrigan, and Jay Campbell. Gentlemen, welcome.
Thank you.
Well, thank you.
Thank you, Joe.
Good to be here.
Let's just jump right in. Barak, let's start talking with a U.S. natural gas outlook. What are you seeing as the key structural changes coming between now and 2040?
Thank you, Jeff. Jeff, let me just start with the punchline and cover some of the key insights. First, we expect that the U.S. natural gas prices will continue going up. More important, we think that the overall margins, average margins, are going to keep increasing. But most important, we're going to be looking at a picture of haves and have-nots, meaning the low-cost producers of today are going to increase better margins in the future, but the high-cost producers of today will struggle even more so than they do today. Now let's talk about what is really driving this, which is really just the supply-demand fundamentals. On the supply side, you really have two key drivers. First, the remaining inventories are getting really thin really rapidly. For example, if you look at each of the key gas basins, the top 5 producers' average remaining inventory is below 15 years. Second driver is that the remainder acreage's quality is actually declining. For example, in Marcellus, the acreage quality is declining the fastest and the most among all the key gas basins. Now, it is not just the average quality declining, but it's also differentiation in quality. Some of the large producers with strong balance sheets are actually choosing not to monetize, put into production all of their tier 1 acreage, realizing that there are some good times in the fundamentals coming ahead. Put those together, you're really looking at the cost curve not only shifting up, but also getting steeper. On the demand side, we also have two key drivers. First one is LNG. LNG, the big story. Since really 2015, 2016, now we're in the midst of the second wave of U.S. LNG. LNG is a great story from a gas demand perspective, but at the same time, being connected to the volatile global LNG markets is going to make the gas pricing also more volatile. Second driver is data centers. Data centers will continue expanding. Later on, we will get into detail. And data centers will be mostly fueled by gas, which is also a positive story because that is going to increase your demand on gas production. Put those two together, you're looking at, on the demand side, the demand curve shifting to the right, so getting better, higher, but at the same time, because of the volatility, the demand curve getting more volatile at the end of the cost curve. Now, put those two together, we'll look at the supply-demand picture together. You're looking on the supply side, the cost curve, the supply side going up, but also becoming steeper, more differentiated. And on the demand side, the demand increasing, moving to the right, but also getting more volatile. What does that mean, really? It is really, as we said, a picture of haves and have-nots. And it paints a picture of both opportunity and challenges. For example, for the strong performers of today, there are opportunities in portfolio strategy when it comes to acquisitions or when it comes to a wiser pace of development, and also in commercial strategy, including trading and also partnerships across the value chain. For weaker performers of today, they really need to focus on fine-tuning their strategy and improving their operational excellence really soon. If they do not, given declining acreage quality and the volatility that we expect to see and the haves and have-nots, they're going to find themselves in a bind much sooner than expected.
Thank you. John, Jay, any thoughts?
Sure. I think I think he did a really good job of laying out the big picture here and all the elements. I think there's some nuance in around some of the midstream architecture that has to be developed, and we'll probably get into that a little bit later, but also the associated gas that's coming out of the Permian is part and parcel of that. But given that it's got sort of what you could consider as a sort of zero cost base because it's subsidized by the crude oil sales, that gas is going to play sort of the base load level gas that will be feeding these new markets. And Jay will probably talk a little bit about locations of data centers in proximity to those cheaper cost supplies. So I think that's going to that's going to play a role. And I bring this up because it also ties into the LNG a little bit in terms of there's still a lot of old LNG contracts that, and even some of the newer ones, are still tagged to crude oil pricing. So one of the challenges that the industry will face is, will we have a high gas price, low oil price environment, or if both go up? So there's some dynamics in there that'll make this very interesting. And of course, that's the old adage, the curse of may you live in interesting times.
Yeah.
So I think we're going to be looking forward to that over the next couple of years. But definitely what Barak laid out.
Definitely. Jay, any thoughts?
As I thought about this whole situation with natural gas and how that's going to play out and what Brock was just laying through, I'm thinking about the M&A landscape. And specifically, I'm thinking about how do those operators that don't have the inventory, what does their future look like? Yes, you can cut costs, but that doesn't change long term when you're talking over a span of 5 or 10 years. That might slow the decline, but really you're probably looking at those companies being acquired and adding to the inventory of the much larger operators. The other interesting thing I think about too is what's going to happen with the midstream infrastructure. And John, you may have some thoughts on that, is as these wells decline and you start to look at inventory declining, but you have gas there, it's almost stranded, it needs to get out. But how do you convince midstream operators to want to put the pipe in the ground and make a 10, 20-year investment when they don't see a long-term play? And so what happens with that gas? Yes, it's there, but it's stranded. And so how does that play into the market dynamics here?
That's going to be a tricky decision really for the midstream players because of, you always want to be the first into a new area. But to your point is, if that area is going to be to the right-hand side of the supply curve and it's going to be the first place you cut capital, when the producers cut capital, that means the volumes decline and you end up with these stranded midstream assets. And that's going to be a tough decision for the midstream players as they go forward.
Barak, follow-up question. How would you respond to the folks that say there's abundant gas and we've got plenty of gas for decades to come here in the U.S.?
Yeah, great question, Jeff. Let's address that notion. You hear this quite a bit. We have so much gas. We have at least 100 years of gas in the U.S., so on and so forth. So for our analysis, we used quite a bit of proprietary data, but we also looked at a number of external sources. Pretty much when you bring it all together, in the mid case, you're roughly looking at the U.S. at this point has about 3,000 TCF, trillion cubic feet of gas remaining. Of that 3,000 TCF, about 20%, 600 TCF is proved, and the remainder, 80%, is about unproved. So when you run the math, it really corresponds to about 15 years, 1/5, of proved gas remaining at current production levels. If you add the unproved on top, it gives you another 60 years. So the argument more specifically really could be, hey, we have 15 to 75 years of gas remaining. Now, of course, the fundamental flaw in that argument is U.S. is not a singular entity. We don't have a single source of supply connected to a single pocket of demand connected with a perfect infrastructure. Now, as John and Jay alluded to, really the big bottleneck here, the big challenge we're facing is infrastructure. Gathering and processing, pipelines, storage, outside hardware. You're looking at trading, better partnerships across the value chain. That is the bottleneck. Now, the key point we're trying to make is we're not trying to be alarmist, but the key point we're trying to make is the challenge is much sooner and much bigger than people expect it to be. And so what specifically can we do about it? When it comes to specific basins or where you play in the value chain, what specific strategic implications are there that we can actually do? We're going to cover that later in this podcast.
All right. John or Jay, anything to add?
Yeah, I think it all comes down to cost, right? And is the market going to be there to absorb the cost? So as Barak was talking about, we're moving into those second and third tier resources, and they're there. We know they're there. And the challenge will be, will the pricing be there to make them economical to develop? And I think there's this assumption of long-term low-cost gas. That's very different than long-term gas. And
It's very true.
right. And as we all know that, high prices bring innovation. and other turmoil brings innovation, and I think that's going to be up to the industry. It's a very innovative industry. We saw the core economics of, well, the whole shale play came from that, right? Prices got high enough to develop the technologies around shale. Then in 2015, the price collapsed. People got really innovative on how to access those reserves at a much lower cost. And there's been plenty said about that. Now the question becomes, as we look to these second and third tier resources, will the industry innovate to bring those in line to create that 100-year resource into a low-cost 100-year resource? And I think that's where, and Jay's probably a lot more familiar with this, the industry is a little bit challenged in terms of investment, right? We've been, since 2015, on a very conservative profile of capital investment. That includes R&D. They continue to innovate, but this may be a step change in innovation. I don't know, Jay, what do you think in terms of that?
There's definitely a question of innovation. We're leaving a lot of gas in the ground. We're leaving a lot of oil in the ground, for that matter, too. Getting to it what price is the core question that you raised, and it is on everybody's mind. Is it there? Yes. Is it there economically? How long? Mm-hmm. I think the analysis that we ran and the white paper we put out shows that there are some operators that have been sitting on their tier 1 assets in the big gas basins, and they're allowing the market pricing to adjust before they start using that. It's a great play if you have the cash to do that. Other operators, they don't have a choice because that is their basin, and they have to continue to drill and they have to continue to produce. Now they don't have to do it crazy, and they're doing it with a very cash flow minded, capital investment minded approach. But as an entity, they have to continue to exist. And unless they get acquired, they will continue to drill up tier 1 inventory and keep prices down. What's going to eventually happen is that tier 1 inventory starts to decline, prices start to move up, because their cost structure moves up, putting a pinch on supply, and then what happens? And again, it's gas is different than oil in that it is all a question of where do the pipes lead, and how many pipes do you have, and how big is that capacity? So,
building on John's and Jay's comments, maybe two quick comments here is, as John alluded to, really the era of easy gas is over. We had a number of years now where we had associate gas that we did not know what to do with. Some of it we still are trying to find a good use for. That is on the decline. Even on the dry gas basins, you were looking at some really good quality acreage. That is over. So there's some tough decisions coming up. And on the other side, as Jay alluded to, the price is an indicator and the costs are going to follow. Now, we're in this complacent period where folks are thinking, Henry Hub price approaching $5 per million BTU. This is great because your costs are locked in, your vendors, so on and so forth. But around the curve, your costs are going to catch up. And when that happens, just maybe 12 months, maybe just a few years from now, then you're going to be in a bind if you are a high-cost producer.
Let's switch gears and talk about LNG for a minute. John, can you share the overall outlook on global LNG?
Sure. It's always good to be able to talk to something that's very happy and growth-oriented, as opposed to talking about challenges and things like that. But with growth comes challenges, and right now the U.S. is the leader in LNG. Qatar is, we've sort of barely unseated Qatar. They've got a big expansion going on. We've got a bigger expansion going on, so we're going to remain the leader for quite a while. And when I say quite a while, I'm saying 2030 to 2035 at least. There's other sources of LNG, many of which are somewhat unreliable because of political uncertainty and things like that. So when I talk, I'm really talking about the big players, Australia, Qatar, and the U.S. But there's a tremendous amount of growth coming. We've already seen, growth in the U.S. in 25. We start out the year around 14 BCF a day of exports. That's 18 now, and probably going to finish the year around 20 BCF a day of exports. That's huge, right? 4 BCF a day is bigger than New York City and Boston combined in terms of daily demand. It's hard to imagine us adding a new New York City source of demand every
Right.
every year for the next 10 years. But that's kind of what the LNG picture looks like, is something of that magnitude. We've been lucky. Demand has been robust. The Ukrainian war really transformed the demand for LNG. Prior to that, Europe was, moving towards renewables, the decline in natural gas consumption. They were still bringing in over half their, well, not half, about 40% of their volumes coming in from Russia. That's gone. That's been largely replaced by U.S. LNG because we have logistics advantage. And then Asia kept growing. So we've got a lot of things, a lot of tailwinds pushing us forward as we grow, and that's going to continue into the future. So I think it's a really good picture. And when we talk about the growth, it's important to note that we're talking about projects that have hit FID and they've passed FID. So these aren't planned, because we always get into that trap of we see this giant number that's planned, but only a portion gets built. Well, once it hits FID, it's real. It's real. It typically gets built. The one challenge we're going to have is that because LNG is very chunky, right? We come on in 1 to 2 BCF chunks for every project. So again, the world isn't creating a new New York City in demand every 6 months. So what's going to happen is LNG is going to go into a short-term glut. So we're going to have more capacity than we have demand. That's going to put pressure on LNG prices because we have a higher percentage of LNG going into spot markets. Most of it is, even the non-spot cargoes are being indexed to Henry Hub and not crude oil. There's still a ton of contracts out there, 20-year contracts tied to crude oil, and that's still going to be the case. However, that glut is going to impact and feed back into Henry Hub. And this is one of those dynamics where the demand is there because we need to fill the plants, but if the plants don't have a home, if the gas coming out of the plants don't have a home, then that's going to back up into the plants, and that's going to put some pressure on Henry Hub, or maybe take some of the upward pressure off the Henry Hub. We've got to see how that plays out. It's not, and it'll probably be seasonal, right? Because LNG is still a seasonal demand. Even though the plants are base load, the actual demand is still seasonal. So we'll see some winter peaks and some summer or some shoulder month doldrums. And that's going to impact what the producers are going to have to face. But that period shouldn't be more than 2 to 3 years. We faced the same thing in that 2015 buildup, and it followed a couple of years where there was excess boat capacity, LNG prices collapsed. And what happens when that happens is the industry can do a few things to sort of soften the blow. And one thing that they did last time that we may see this, even though a project is post-FID, even if it's under construction, even if it's just before commissioning, they can slow that down to give demand some time
to catch up.
And usually that's driven by the off-takers who will call the developer and say, hey, don't push so fast. Let's slow it down. It's okay if we push. However, for a lot of these projects, they've been on the books a while, and their permits with the FERC require a commissioning date. So there's going to need to be some flexibility that's market sensitive by the FERC to say, yes, now's not the time to be, rigid on these startup dates. Let's give everybody some cushion, 6 months to a year, to kind of let the market catch up to all this resource that's going to be leaving our shores.
Great.
John, does the current LNG market anticipate peace in Europe? And what's going to happen there? Because that's a big question in my mind.
You know, what is it, the black swan or the I mean, the big thing is obviously everybody's pushing for peace right now in Ukraine. There's, you know, we really hope it happens soon. There's a secondary decision, and that is how that peace comes about, what that final settlement looks like will probably impact whether European demand centers feel confident to rely on Russian pipeline gas again. If it gets resolved in a way where they can get comfortable with that, then what you'll see is over a few years that pipeline coming back into the European market, and that could have a significant downward pressure on U.S. LNG demand because we are sending a lot of cargoes over that way, and we can't compete with Russian pipeline gas. Well, let me rephrase that. We don't want to compete with Russian pipeline gas in that scenario. So I think that's going to be the big binary outcome. Right now, the way it looks, I think it's a low probability that they'll bring it back. If they do bring it back, I'd say the probability is that it's going to be sort of spot gas. They'll buy it spot. They're not going to base load. They're not going to build their supply portfolios around it because it's proven inherently unreliable. Which brings up another point, and that is we've been going through a lot of trade wars this year, and we could be creating some of that same problem with some of our trade strategies. So there's got to be some change in how that works as well to kind of solidify those markets long term. So far, there hasn't been an impact, and knock on wood, we're not going to see an impact. But the reason this is a strategic commodity, right? It's energy, it supports strategic industries, and reliability is right up there with cost in terms of portfolio priority. So we've got to make sure that we keep those elements in place and not ruin our markets by trade issues and other aspects.
Got it.
And if we're right about the overall supply situation and maybe not being as rosy as some people are saying, I'm curious about you guys' thoughts on what happens in the case where maybe a new administration comes in and similar to Biden administration starts putting pauses on LNG development, or maybe what happens is we realize, hey, we need all that gas for U.S. purposes for power gen. Does that play a market in how LNG markets are thinking, or is that something that is more seen that could happen but probably not likely?
I think it's, and I'll give you a quick answer, and then I'll put all the burden on Barack here. There is a point at which gas prices get high enough to impact the economy or specific segments of the economy, right? So I'll start with the easy one. So still probably the biggest demand is building heating, including residential. And that is a pocketbook issue. And I think the phrase everybody's using this year is affordability. I don't know what the price is when that triggers political interest, but it's probably around $7, right? So $7, if I put on my yesteryear hat, goes back to 2007, and people were screaming. That's when renewables got really kicked off, is because, okay, $7.
We need an alternative.
Yeah, what's the alternative? So, you could see restrictions on exports, right? So everybody operates under an export license. Those licenses can be modified by policy. And so there are some things that they could do. The other thing is, and I know you're going to talk about data centers soon, that's considered a strategic industry, right? And one of our strategic advantages outside of the pure technology aspect of it is our low energy cost, right? Nobody wants to go somewhere where the energy is expensive to build a data center. They want to go where it's cheap. So if we're exporting LNG and driving up the price of gas, which is increasing the cost of electricity and energy for data centers, somebody might throw a flag, given this is football season. They're going to throw a flag and say it's time to regulate what we're sending overseas, or, and I'll turn it over to Barak now, to incent more drilling to keep the price low.
3 quick points on this one. Oversupply. What to do with oversupply. The good data point, and we've seen this in late 2010s play out as well, is globally now you have about 2.5 times as much regasification capacity on the receiving end than you have on the liquefaction side, which is the sending out part, which gives you a lot more flexibility. Yeah, liquefaction is a lot more expensive to build and to operate. A fridge is much more expensive to build and operate than a toaster. And these toasters, you really don't need to heat them up that much. Yeah, that's how simple regas is. What does that mean? That means it gives you a lot of flexibility on when to turn down and substitute coal for gas. When the LNG price gets low enough, through 2030s roughly, as we talked about, India is going to say, I got a big pollution problem. Yes, I want to keep my coal mines and coal plants running, but at the same time, these are lignites. Well, LNG price is low enough. I'm going to switch from coal to gas. So you do have that flexibility, and it's not just speculation. We've seen this in the late 2010s when Chinese pollution was so bad, China did the same thing. Later on, they had a really smart approach. They moved their coal plants away from the cities, and close to the cities, they built nuclear plants. And their economy is not as good, so probably LNG growth is not going to be as strong in China. So that's the oversupply story.
We hope you've enjoyed the first half of this conversation on U.S. natural gas strategies. Please join us for the next episode of The Next Imperative, where we'll continue and finish the conversation.
Thank you for listening. Make sure to subscribe to The Next Imperative so you never miss a new episode. Also, visit our website at alvarezandmarsal.com to learn more and to connect with us.